Chart decreasing. The U.S. real estate market is experiencing something that seems to defy basic economic logic. Home sales have fallen to their lowest level since 1995, but prices remain near record highs. Fewer buyers, higher prices. In any normal market, this shouldn't be happening. But here we are, facing a practically frozen sector. House today, the median price of a home is around $418,000 US, compared to $272,000 US in 2019. A jump of almost 50% in just 7 years. And we're not talking about Manhattan or Palo Alto, but the national average. To make matters worse, mortgage rates, which were at 2.65% in 2021, are now around 6.5%. This means that the same house can cost $730 US more per month in interest alone, in addition to having increased by more than $140,000 US in purchase price. Fire, how did we get here? The sequence begins in 2020, when the Federal Reserve cut interest rates to virtually zero and poured billions into the financial system. At the same time, the pandemic transformed the home into an office, school, and gym, leading millions to seek larger homes in cheaper cities. The result was an explosion in prices. Between 2020 and 2022, the average home value rose 37% in just 2 years. Chart increasing, but when inflation surged in 2022, the Fed reacted with the most aggressive interest rate hike in 4 decades. Mortgages jumped to almost 8%, making homeownership unaffordable for millions. And here's the paradox: even with fewer buyers, prices didn't fall.
Why?
Because those who already have an older mortgage with low interest rates are stuck with it. More than half of current contracts have rates below 4%, and selling would mean exchanging it for much more expensive debt. The result: nobody wants to part with their home, and the stock of available properties plummeted. Woman health worker. To understand the impact, consider Maya, 31 years old, with an annual income of $74,000, excellent credit, and significant savings. Even so, the median home in her city would consume 65% of her net monthly income. This isn't irresponsibility, it's pure mathematics. The market demands an income of $110,000 to buy the typical property, while the average family income is $83,700. Baby, this has enormous social consequences. The average age of a first-time homebuyer is now 40, compared to 28 in the 1990s. Millions of young people are postponing marriage, children, and other milestones of adulthood. Meanwhile, boomers are buying outright, using the wealth accumulated over decades of appreciation. Hammer, the problem didn't begin with the pandemic. Since 2008, the U.S. has failed to build between 3.5 and 4.5 million necessary homes. The housing deficit has been exacerbated by material costs and builders' preference for luxury properties. The structural shortage is so great that even a drop in interest rates could temporarily worsen the situation. More buyers would return to the market, but without sufficient supply, prices could skyrocket again. Balance scale. The truth is that we are not facing a collapse like in 2008. Credit is solid today, borrowers are qualified, and most have positive equity. The problem is different: a stagnant, expensive, and structurally unbalanced market. The solution will not come in months, but in years. Light bulb. So, what to do? The rule of thumb remains clear: if housing costs don't fall below 30% of gross income, buying doesn't make sense. Renting and investing the difference can be just as valid a strategy as buying a property. And if you do buy, considering new constructions might be an option, as many offer incentives and reduced rates. This is a picture of a market that isn't collapsing, but rather frozen. It's not that you're failing to achieve homeownership, it's that the math is broken. Understanding this is the first step to making smart decisions and not falling for the narrative that it's always a good time to buy.